because if you look at what we've had, the fundamentals we would say are still talking about mid-50s for the long run, the 12-month view on the oil price. But what we've seen in these previous episodes where you've had sharp rises in the oil price because of geopolitical events, that tends to destabilise. It tends to favour the US market, ironically, even though that's the expensive one, at the expense of Asian markets, at the expense of European markets to some extent as well. And also Japan tends to hold up reasonably well in this kind of environment when you get a bit more of a risk-off trade coming through.
I know it's still early days, Ian, but clearly this is going to have implications for central bank policy, especially if this move in oil is sustained. It will have a knock-on effect on the inflationary impulses, and central banks like the Fed possibly may have to move faster. Is that where a policy error in terms of pushing these markets lower comes in?
I think that's one of the interesting questions, which is how policymakers respond to this. They've actually been desperate for inflation to go up. Now we might get some of that because of the higher oil prices. But the only question is, if it's a disorderly market in terms of equity markets coming off in response to that, will they start to say, well, actually, this is a tricky environment for us to actually be tightening policy. Let's look through that short-term rise in the inflation rate because of oil, and actually let's pull back from some of that quantitative tightening, some of that tapering that we've already talked about for the markets, because we're worried about those financial conditions indicators that that William Dudley particularly has been focusing on in the FOMC, and that is whether they'd actually pull back from tightening too rapidly. So I think it's going to be a fascinating environment. But what you're talking about is heightened uncertainty for markets, and we know that with the VIX so low, that's the thing that could actually really destabilise these markets.
I love your comment about inflation. I've been likening it to a dog chasing the fender on a car. I mean, it's fun while you're doing it, but what do you do with it once you get there, right?
There's different types of, there's good and there's bad inflation, isn't there, Bernard? What we actually want is an inflation that comes through because economic activity is picking up aggressively. We're getting pricing power for the corporate sector, and you're getting those earnings numbers coming through. Whilst this might be great for the oil sector's earnings short term, for the rest of the market, actually it's pretty disastrous.